Ladies and gentlemen, the crypto space. We're live on a Monday, April 11th at 11:30 a.m. I was off all last week. It is what it is. I had some work conferences on Monday and Tuesday and the Bitcoin conference on Wednesday, Thursday, and Friday. A lot of things I saw at the Bitcoin conference. There was obviously a plethora of vendors and manufacturers and businesses related to Bitcoin, mining, hardware mining, which is quite interesting. It's a very interesting industry, especially how it folds into power generation and the stability of electrical grids, so on and so forth. There's some definitely things that I've been thinking about in that regard. But aside from that, what are we here for? We're here for understanding what the hell is going on in the crypto space, in the markets, in the price action of these assets. Now, what did I see at the Bitcoin conference? Obviously, massive exuberance, people absolutely loving Bitcoin and the narrative, and I appreciate that. I myself subscribe to the notion of sound money and the Bitcoin narrative, and I love that. I love the technology. I love the notion of payment processing. I love even more so nowadays the notion of using Bitcoin as collateral to back a stable coin. You want a stable price point asset, maybe inflation protected like FPI. And obviously, UST is what is buying Bitcoin to back it. And I think this type of iteration of monetary policy on top of a strong collateral asset that is what Bitcoin is, it makes sense. And these are the types of things that will prove meaningful, structurally meaningful, as the financial system unfolds. So overall, the narratives are there. The narratives for our altcoin assets are still there. The curve narrative, and it's not just curve, it's all the assets that are associated with it. All of this is still there. Nothing has changed. Obviously, the price point is completely screwed. That's because the narrative has nothing to do with price action. And what do I talk about pretty much predominantly nowadays? The macroeconomic situation. Now, that's what drives price point. Price point doesn't drive itself. Technicals don't mean shit really with regard to the directionality of markets. What drives price action of markets is really the OTC derivatives market and the Eurodollar market to the tune of quadrillions of dollars. So the OTC derivatives market, let's pop it over to the main screen, is really why I look at the 10-year, because the 10-year is the short end of the long end of the curve. And the long end of the curve between the 10 to the 30 is really like public facing bonds. It's not banks, it's not corporations. Shorter end treasuries, T bills, so on and so forth, are used by banks to balance the books, but the long end is collateral. Um, the OTC derivatives market is the largest market in the world, so they need the most collateral, and the US Treasuries are that collateral. So if we get into a pinch where maybe the collateral value implodes, yields going up is the collateral value completely imploding. What happens when your health factor on an AVE position gets down to like 1.1? Oh, and that's where you see obviously historic trend reversal in bond markets, particularly this chart, the 10-year. You see the reversal. So there's a lot here because obviously this period of time was where Powell flip flopped from QT to QE. He was fearful of a structural change in the bond market, obviously breaking the trend. And that's exactly where we are right now. So, what does that mean? We're at a crossroads where maybe there isn't excessive leverage in the OTC derivatives market and they don't need to recollateralize positions, up the collateral so they avoid margin calls or meet margin call expectations and avoid liquidations. And maybe the bond market just keeps selling because they're shit. So who knows? We'll see as the price action unfolds, as the yield chart that we're looking at unfolds. But what if it breaks through trend? And that's what Japan's dealing with. Japan's dealing with yield curve control. And when the Fed or the Japanese central bank uh, offers to buy an unlimited quantity of sovereign debt, it's basically a sacrifice of the currency. So the yen did what it did against the dollar over the last week or two or three of their yield curve control. Um, it's a favoring the debt market to strengthen the debt market, to stabilize the debt market, sacrificing the currency. Nobody wants to own some shit that the government owns. If it's controlled, there's going to be no appreciation or depreciation. The central bank is basically taking ownership of the price point so they can control it. So um, different things will happen if the U.S. does yield curve control. It's not the same as Japan doing yield curve control or the ECB. If the ECB does yield curve control, which Lagarde literally said that's what they're going to probably have to do, then we'll see the DXY absolutely do really ridiculous stuff. We'll see some serious volatility to the upside because that's the sacrifice of the two primary components of the DXY, the euro and yen. So this thing will completely rip to the upside. But if I was speculating conspiracy theory that if the ECB and the Fed coordinate and do yield curve control simultaneously, basically the DXY could remain flat. So currencies are all relative, meaning as the so if and it's relative to the printer velocity. So if they're all printing, you're not going to have the volatility, and they probably will have to coordinate to some degree because if you get excess volatility in the currency markets, this is where the risk in the OTC derivatives markets comes in. I believe it's $550 trillion worth of OTC forex derivatives, or the numbers are absolutely staggering. And if there's volatility there, you get issues with collateral, you get margin calls, and then you get exactly what has happened in the bond market over the years, a completely sharp reversal to the downside on yields because they're buying as many bonds as they can in order to shore up a $550 trillion market. So really where we're at, as I said, is a crossroads, and I expect extreme volatility. I have zero trust in these markets because we're dealing with $750 trillion, give or take, of OTC derivatives, and whatever the hell is going on in the opaque Eurodollar market. That's a Jeff Snyder territory, but that is even bigger. We're dealing with markets that are countless multiples the size of the entire stock market. They make the crypto space look like zero. So what happens when you have a margin call? You basically sell anything that's not nailed down to prevent the liquidation of a, you know, $500 trillion currency derivatives market. You sell everything. So that's exactly what we've seen. And, I'm not going to label '08 that. It was different, but let's say that's what we see when the market collapses. It's the liquidation of shit in the equities market to basically come up with dollars, to sell anything you can in order to come up with capital in order to buy the stuff you need by selling the stuff that you don't need. And it's wild. So the title of the stream is Optimal Mentality, and that's all we really talk about is how to, well, I obviously talk a lot about macro, but this all plays into how I think about the market, and probably more so now than ever is imperative to have the correct, or at least a sustainable mindset, how to think about your portfolio and the structure of the portfolio. So over the years, we've talked about fancy things like LP positions and revenue streams and yield and cash flow and the pizza shop narrative, which is still wonderful. Um, but these were very bullish times in 2020, 2021. We had very, very bullish periods. Even our periods of depreciation were overcome with subsequent periods of appreciation. But right now, that's not the case. This is a bearish market where periods of appreciation are being overcome by periods of depreciation. There's more depreciation than appreciation. So we're not going to zoom out to the yearly because there's plenty of folks that have that type of perspective, but there's so much capital to be made looking at the monthly or the weekly that I don't want to look at the yearly chart. I'm not that kind of long-term investor. I want to get multiples on the capital on interest cycle volatility. So there's no reason to be overexposed to a market like this. And generally, as I share in Discord, the portfolio structure currently about 42% stables, and any other asset in my possession is locked. So it has basically no capacity to be sold. So that's great. And these are all interest bearing assets. And these assets produce revenue, and that revenue gets added to the cash position and, pretty much income. It's taxed as income. So that's your savings account. So the cash position is growing. You could use it. You could spend it. What is buying an asset? You're spending. Whether you're spending on food, a car, insurance, or living expenses, or buying an asset, it's an expense. So a stablecoin position is structurally identical to a savings account, and that's the best way to think about it. Um, Obviously, any positions in these markets should be are only lock positions, because if you could sell it, you probably should have already. So I expect my asset positions to be extremely volatile, and I don't expect them to appreciate. They appreciate, yay, that's nice. I don't expect them to. I expect them to go down. If I expect them to go down and they go up, yay, that's good. But what do I know that I have is stable assets that aren't going to depreciate. Stable coins are nominally priced. They're going to be that price. They're redeemable for US dollar currency at that price, independent of the DeFi relative price point. And DeFi Forex markets, the swap rate slippage are irrelevant, because you could redeem these stable coins at Coinbase or Gemini for a dollar 1-to-1, because that's the way the platform has been implemented. Tether's another story. It's not a redeemable asset, but USDC and GUSD are redeemable 1-to-1 for dollars. That's the way they're built. So I'm going to hit some questions, try and help you guys out. But personally, I love this kind of market. I love all kinds of markets. I see so many folks exiting the space, but this is such a critical market to understand and not to fear, to understand it's depreciating, but that's why we've been here for 2+ years. We experience appreciation. Now we're experiencing depreciation. And all I talk about on Twitter is when we're going to experience appreciation again. The appreciation's coming is when the Fed realizes everything is so screwed that they have no other choice to intervene in the market. I literally just posted a tweet probably shortly ago about it being the Fed intervention cycle. There's no more business cycle. There's no more rate cycle. It's the Fed intervention. The market cracks until everything tries to shit the bed, and the Fed intervenes on it. That's just the way it works. And when they intervene, and the next time they say yield curve control, that's basically when you buy everything that's not nailed down. And in the meantime, there's really nothing to search for. Don't waste your time searching for yield, because the principal position is going to get outright hammered. Don't waste your time trying to trade unless you're into that type of shit. But I have no interest in trading, so I'm not out there trying to make a buck on a daily basis. I always tell you guys that the goal is the structure of the portfolio, and a well structured portfolio means you're respecting the portfolio. And if you respect the portfolio, it will respect you. Literally, if the structure of your portfolio makes sense in a bullish market right now, then you're good. You just have to wait for the shit to clear, the storm to clear. And when then there's clear skies, the portfolio is going to do well. What you want to do is structure the portfolio such that it could weather the storm well. I of the capital in my portfolio that's allocated to assets depreciates by 50%. All right, it is what it is. In the meantime, it's generating revenue, which goes over to the stablecoin position. And I would hope you've carved out enough stablecoins such that if you measure your stablecoin stack relative to what you started with in 2018, 2019, 2020, you've done well. You've grown your savings. Then you're heading in the right direction. Um, and this really leads me into thinking of how to structure the portfolio even in the most bullish of times. You really want the stable coins. The stable coins allow you to service nominal debt, allow you to pay for inflating consumer priced items. That's besides the point. Um, but you always have to be ready to liquidate positions to grow the stable stack. The stable stack is nominally assessed. It's a price point. Even considering inflation, you have 100,000, then you have 200,000, then you have 300,000. That means you're heading in the right direction. And obviously, you need to grow that stack to account for consumer price inflation. So you have to grow it meaningfully. But that's really the only way to assess the health of the portfolio. Because sure, you get the value of your volatile assets, the spot price at any given time, but it's a moving target. You're going to drive yourself nuts with anxiety and frustration. So, the title of the stream is optimal mentality of how to handle this stuff. So if you expect your volatile assets to be extremely volatile all over the place, carve it out psychologically. Think about it as not a dispensable part of the portfolio where, okay, it goes to zero because that's obviously painful, but it's your working capital. It's your pizza shop. But the only real way to assess where you are and how your relative degree of success is your savings account. It's the stable component of the portfolio. So just like if you own pizza shops, like a chain of 5 pizza shops, generating revenue, you're taking a salary. You're paying your bills. You're saving in a savings account. So take your damn salary, your save your savings, and do as you normally would just in a digital environment with the crypto space. You need to strongly and ferociously compartmentalize the portfolio and think about different parts of the portfolio in different ways. And that will help you maintain sanity in this extraordinarily volatile market. 49 people in the stream, 11 likes. We can do a little bit better. Let's get to some questions and see if I can help you guys out. Gears in the house, upon. Good afternoon, Raul, Dan, morning. Wow, what a day. One heck of a day. These charts are ridiculous. If you take a look at the 4 hour on Ethereum, it's pushing up against resistance on the 200 SMA. So it broke to the downside and then it tried to retest to the upside and it's pushing back down to the downside. There's literally no support on this chart whatsoever. It's literally just smooth sailing all the way down on the 4 hours. So if you go out to the daily, I think you see the 100 SMA. It is a bullish cross of the 50 SMA and the 100 SMA. Um, so technically, it's still trending upward over a longer time horizon from a daily perspective. And if you go out to the weekly, you still see overtones of potential bullishness. You got the TWAP below, you got the 10 SMA below. But this type of volatility where you have a bearish engulfing candle, and then you just have continued bearishness, which is a confirmation of the bearish engulfing candle. So a bearish engulfing candle is indicative of trend directionality change, and then you literally have a confirmation of it, which combined with a breach below the 50 SMA on the weekly, this has overtones of just depreciative pressure behind it. It'll push through the TWAP, it'll push through the 10 SMA, and we'll be lucky to find support at the bottom of the Keltner channels and the 100 SMA down below at around 2,000. And that's the way these markets work. They taketh as much as they giveth, and maybe they taketh even more. So patience, and the chart to look at isn't the damn crypto charts. This is the biggest lesson I've learned from historic cycles, obviously playing 2016, 17, 2018, end of 2018 just was exactly where Powell pivoted. Where do you think 2018 is? Don't you guys remember 2018 when the market shit the bed and continued to shit the bed through 2019? Right here, November 2018. When, I mean, literally, this has the crypto space written all over it. So this is where to look to understand the directionality of the crypto space, the bond market. And how do you concentrate the bond market into a single chart that's kind of sort of representative of the overall state of the bond market? It's the 10-year. So we're exactly where we were in 2018, where literally the crypto space started its 1.5 year bear market. Now, I don't think we're going to have that duration bear market this time. I think the market is absolutely screwed the pooch past the point of no return. So what will likely happen is a shorter period of bearishness, maybe more consistent with like October, November, December of 2020. So May 2020 to September 2020, end of September 2020, we had a heck of a rip. That was DeFi summer. But then it's October, November, December, we had bearishness until January 2021. So maybe we'll have 3 months, 4 months, 5 months of an absolutely uncomfortable market to interact with. But something's going to happen. We're going to have a capitulation event. We're going to have a liquidity crisis. We're going to have a margin call in the derivatives market, and the bond market is going to go absolutely vertical to the upside, which basically means this chart will go absolutely vertical to the downside, and they'll have to intervene. So it's just what I said earlier, where the market is basically reduced to the Fed intervention cycle. And that's why we see everything that's going on in China with their CBDCs. That's why we see all this talk where the ECB said we're probably going to need a central bank digital currency. That's the last thing they said about a CBDC. And why would they need a CBDC? For the very reason we talk about this stuff. They need monetary policy control. And what kind of control? The same stuff we see in the DeFi space. Capital controls, control over inflation, control over deflation, mutable monetary policy. And the Fed's working with like levers. They got absolutely no control over anything. Basically, like punting things and, oh, maybe it'll work. I hope it works. Let's wait and see. That's why every time they adjust monetary policy, it's like, let's wait and see what happens because they have no control over anything. Absolutely infuriating in many regards. Didn't the markets dip last year after BTC conference as well? Yes, it did. So 2021 May. So if you look at the bond market, April, look at yields. Look at the volatility on yields in 2021. Anytime you see a directionality shift in the bond market, it spooks the crap out of equities and other risk assets, the smaller asset classes. So the bond market is large as compared to the equities market, and the equities market is large compared to the crypto space. So anytime you have a sharp directionality shift in the bond market, you're going to experience basically broad volatility in the smaller markets. And look at that. There's April and here's May. So there's a sharp change in the directionality of the bond market, and that's exactly what you're talking about, Dan. Who's in the house. Adam, hope you had a fun week away. Looking forward to the macro thoughts today. Yes, it was good to get away. It was good to see the state of the general public. There's a lot of interest, and I like that. It's important. I did post like I would love for them to rip interest rates to 15%. They'll never be able to do it. But it would be nice to live a simple life, back in the 60s where you could save and you got like 15, 20% interest rates on a bank account. That'd be nice, but it's not possible. So the reality is what's neat, what we see at the Bitcoin conference, what we see at all we do with our activity in the crypto space, this is necessary. It's necessary to be able to navigate the shit show that they've created uh, in the global financial system. So these are very powerful tools, and it's the directionality of sovereigns with CBDCs. So the better we understand these DeFi protocols, the more we're going to understand how these central bank digital currencies are going to affect the population. And these are pretty much immutable, public, permissionless, disintermediated financial protocols. So it's real stuff. It's maybe an evolution of free banking, but it's not because you didn't have monetary policy like this in any regards. These are very sophisticated, crafty, complicated algorithms and very math intensive manifestations in the smart contracts. So this is deep, sophisticated stuff. So it's not trivial, it's powerful, and the only complexity is that it's volatile because of how small the market is. And what is small? Crypto is smaller than equities. Equities are smaller than bonds. Bonds are smaller than OTC derivatives. OTC derivatives are smaller than the Eurodollar system. So all this shit gets pushed around by giant whales, and these whales aren't like blue whales. These whales are like whales that are 10 times the size of blue whales. And the bond market's a blue whale. And then the stock markets are like an orca or like bluefin tunas, and then the crypto space is like like a salmon. So this is very small stuff that gets pushed around in a very big ocean of a large, very large ocean life. Trying to give you guys a metaphor for how small these markets are that we're dealing with. Lewis is in the house. How are you, my brother? Crypto and legacy are going to get decimated, but life is good and presents opportunities. What are your thoughts, Captain Arthur Hayes? Yeah, he's really smart. I like the way he presented his article. He understands the macro situation. I'm not too much of a fan of price targets. More of a person that looks at the market in terms of directionality. Is it going up? Is it going down? And I look at the economic situation to understand if things are going to turn around. When's the directionality shift? And we talk about that, and we'll continue to talk about it. I'm not going to digress too much right now, but rest of the week, Wednesday and Friday, we'll talk about when the market will start to go up again. And there's plenty of things that we'll talk about that will help understand things to look for when the market will start to be bullish again. And then we could go back to making money instead of protecting money. And then we'll adjust our portfolio structure accordingly. So life is very nice. This is tax week, so we have to figure out how to report our best effort to tax authorities such that we stay in their good graces and everyone is happy, happy, joy, joy, Ren and Stimpy mode all around. Gillis is in the house. How are you? A pleasure. Let me scroll back up. Grisky Crypto, good morning. Lives in the house. I'm okay. I got some work to do for my company, some programming to do, and the portfolio is on autopilot. I don't have many transactions at all to do. That's about it. Otherwise, it's very nice out. Maybe I'll sit outside in the patio for a little bit. Good to have you back. Thank you, Warren. I appreciate it. One Curious View. Pleasure. Can you show where to get the frame wallet extension you mentioned? I believe it's frame.sh. So it's basically MetaMask, except it doesn't suck. So it does the exact same thing as MetaMask. You import from, you connect your ledger to it, and that's it. It's just MetaMask, but good. That's the best way to think about it. Liv W, you paying attention to what's happening in Shanghai? Yeah, it's absolutely dystopian in all regards. It's straight out of like a 1984 book or something. Wild. And it's going to get worse. Commodities price increase are going to cause social unrest. I mean, you don't even have to have like supply unavailability. You just have to have the consumer price inflation. All of a sudden, it's $10 for a loaf of bread. It's people are going to be hungry, and when people are hungry, you get some serious emotions going on. We're entering some wild times. This is not going to be normal in any regard, and I don't see even a liquidity crisis or a currency issue. It's not that's not going to be normal because of the commodities prices, because they can't stop inflation without telling people to stop buying. And if you tell people to stop buying food, holy crap, you get what's going on in Shanghai. We're going to have social unrest. It's pretty wild, and this is a time where where food and bullets are precious things to have. A lot of folks could probably appreciate that. And protect yourself, be safe, stay away from public spaces and big gatherings. And I expect a lot of social unrest. What do you think the Astroport's move, the curve wars with retrograde? I'm completely out of sync with whatever the hell they're doing, but I like the new curve portal. I like their new routing implementation where you could actually trade some stuff that you couldn't on the original Curve 5 portal. So that's a big deal. I think the overall Curve narrative is one of the most moded narratives in the entire crypto space. So every component of my portfolio allocated to the Curve narrative remains. My VEFXS position remains. My CVX position remains. My historic VECRV position remains. Great. I'm more than prepared to watch the volatility, and I look forward to what the market's going to look like for the assets in 3 years, in 5 years. And in the meantime, they generate nice income. In fact, those assets generate more income than I make from work. So the volatility of them, I don't mind much as long as the are continuing to produce income, and they will because they're moated. Um, Market seems to have some bear candles in the 4 hour. Yeah, yes, indeedy. Is it right to say we're waiting for one of these two events to happen? System wide capitulation as the market sells things to buy bonds, or Fed step in with yield control. So we're waiting for we're waiting for many things. What's most pertinent is the market doesn't start going up just because something collapses. The market needs to find the bottom. So after we see some sort of capitulating event, like like bonds completely reverse, bond yields reverse completely to the downside. And why would it do that? Maybe there's an OTC derivatives margin call, and all of a sudden there's $10 trillion worth of buy pressure on bonds. That'll rip it to the downside. There'll be an absolute crisis. The equities markets will implode. The crypto space will implode. And then the Fed comes in and starts issuing debt. And that God says that's a big part of what happened in 2020. They needed a reason to issue a huge amount of capital into the system. Why? Because of what Jeff Snyder talks about, how the system is extraordinarily disinflationary. There isn't enough capital and collateral into the system to handle a margin call in the OTC derivatives market. If OTC derivatives needed to come up with $25 trillion worth of collateral, it's not there. It'll absolutely send shockwaves through the bond market. It'll absolutely liquidate the entire stock market. So there's a deflationary pressure on the entire system because of how disinflationary the currency is, how disinflationary bonds are. The U.S. government is the currency provider for the world, and it doesn't meet demand. It's believe it or not, the U.S. government doesn't issue enough debt. It doesn't issue enough currency. The only way it could issue currency really is by us buying shit overseas, and that's why we exported the entire supply chain over the last 30 years to China, so we could get currency offshore into international markets. But it's getting complicated because I'm not going to get into politics, but it's getting very complicated. Now that there are more protocols that come out and they also lock CVX CRV, what do you think about the pros and cons of this? It's all pros. Curve is being bought and bought and bought by many, many protocols. And Convex because it controls Curve. So this is not a time that I'm even remotely thinking about increasing positions. I'm literally sitting back. I haven't touched anything in the portfolio. The portfolio is what it is, and I have no interest in acquisition or acquiring any more assets. I expect my convex position to look very nice in 2 years. I expect my VE curve position to probably look nice in a couple of years. I expect CVX to outperform CRV. CRV suffers from the rat race syndrome where you need more and more and more for the VECRV position to be productive, and that scenario or that mechanism for capitalizing on curve was resolved with the introduction of the convex protocol, and obviously we have convex wars. But convex doesn't produce, yeah, obviously produces some return from base VE curves, but the primary returns from convex are from third-party protocols and the bribing infrastructure. So I expect that to actually outperform, which is pretty much what Tetranode was talking about when he took his million CVX position. I think he got it, and it took me a bit to see it, but I think he was right. Um, One curious view, Temple Dow is interesting, yeah, but it's out on the risk curve, so it's not of interest to myself. Andrew, great to have you back. It's a pleasure to be back. Quantify, can I ask you what function CVX is performing in your current portfolio balance? Price point stability, revenue, price appreciation. Certainly not price point stability, albeit the price point is actually relatively stable. It's nice to see. Obviously volatile compared to a stable coin, but it's relatively stable. It's above this, green line I have right up here, which was a historic resistance back in October 18th of 21. That's pretty cool to see that it found support there. So a previous resistance held as support. Now, obviously, it's extraordinarily volatile, having breached $60 to the upside and going as low on the dip as $15. That's massive volatility. But if you notice, this green line is right down the middle of the price point, so around $30. That's a heck of a price region, plus or minus $10, which is a massive price range, but it is what it is for the crypto space. That's the type of volatility we expect. It's nice to see it above the TWAP on the weekly. Not going to zoom out to the monthly. There's just not enough chart data. But let's see. I expect extreme deflationary pressure across the entire space, but Convex is a revenue producer. It produces sustainable income from third party sources. It's not inflationary income, and that means everything. So it's a very comfortable part of the portfolio. I expect it to be extremely volatile. I'm prepared for it to go back down to $15 and I'll lose half the value again. It's not something that will be unexpected. And if you are uncomfortable with that kind of volatility, take position size. You need a smaller position and you have more stables to increase the overall stability of the portfolio. And that's how you structure a portfolio that lets you sleep at night, that you're comfortable with. You manage volatility with position size, but you also have to be honest with yourself about how volatile these damn assets are going to be. That's probably the most difficult thing to do. Vaku, Captain about stables. Had interesting discussion with Bebis from Byte Masons the other week. He is warning about stablecoin risks and algorithmic protocols like Luna Abra due to collateral quality. I have only interest in a USDC or a GUSD, and obviously I favor GUSD over USDC. GUSD, the DeFi price could be 10 cents, and if you transfer GUSD to Gemini, they're going to give you $1 in a bank account for it. So I don't go out on the risk curve with regard to stables. I only have interest in stable coins that I could actually redeem for $1 in a bank account. So that's how I handle that. Live, Butterfly, Redacted launched their hidden hand market. I'm very interested in those protocols because they're buying Frax, they're buying Curve, they're probably going to buy FPIS. Yay! Go protocols, go buy everything you want. I'm more than happy to own the assets that they're going out to buy. I have no interest in those protocols. They're second tier protocols. It's just I'm not interested in them at all. Would you be able to go over your approach to managing bribes in a future stream? Bribes are income, sell them for stablecoins. Vaku, potential issues which could lead to huge systemic risk down the road. Yeah, sure. There's a lot of systemic risk. Obviously, Luna has a lot of Bitcoin on the balance sheet. Maybe they'll have to liquidate to maintain their peg. I have no idea. So there's massive systemic risk all over the place. Does that make me worried? Yes. Are these interesting markets? Yes. Is it enough worry to not expose to these markets? No. How do you manage being comfortable being exposed to these markets? Position size. If you're worried about if you've over allocated to a position and you're uncomfortable, make the position smaller. Are you worried that you're not going to make enough money? That's an emotional issue. You got to get over that. You probably want to make money and not lose money. So you got to get into the frame of mind where you want to make less money than you really want to. The second you try and make more money, you're putting more risk on the table and you're more likely to lose money. I would rather make 20% on the money than 200% on the money because the 20% means I put less risk on the table and I was more likely to achieve what I was looking for. I wasn't too greedy. Shoot for 20%, shoot for 30%, shoot for sustainable returns on your portfolio, and you're more likely to succeed at having greater than 51% winners. If you win more than you lose, you're growing your wealth. It means you have a sustainable portfolio. Shisha, Noah, how do you handle these swings? It's been a rough couple of days. Portfolio structure. So, uh, income goes to stables, and that's your savings account. And assets you expect to be volatile, but the assets that I'm exposed to, like FXS and CVX, these are very volatile assets, but they're being bought. And what I love about them is they're bought by protocols that have nothing to do with human behavior. They're bought by protocols, and for those protocols to be successful, they need to buy these assets by mandate. So there's buy pressure. There's mandated buy pressure, which means they're going to be more stable than other volatile assets like Ethereum. Ethereum has buy pressure by market actors that buy into the narrative. But they're not really bought because they give some sort of power, like governance rights or access to disintermediated cash flow. So the assets on Ethereum have very much more sophisticated monetary policy, therefore sophisticated contribution to a portfolio than just Ethereum. So at some point, I would expect the protocols on Ethereum to be more valuable than Ethereum itself, which is quite interesting. So that would really indicate to me real maturation of the market because the software, the contracts that could be written on Ethereum, at some point really should be more valuable than the all Ethereum, the market cap of Ethereum, uh, which is an interesting thought. Um, Losing big, don't lose. Stop. There's no trading in this market. Stop trading. If you're losing, stop. Go to stable coins. You need to rethink that this is not a time to be buying assets at all. This is a time where you get yield and you sell it for stables. You get a bribe, but you sell it for stables, and you compartmentalize the volatile assets as just being volatile. And you're going to expect them to depreciate, but in a year or two, they're going to be more valuable. The Fed is going to have to intervene. The market's going to completely shit the bed. But assets that have a moat, that have a very reasonable and rational path forward, they're going to be here. And that's really what it's about. It's about survival. Any asset that you speculate will survive will serve your portfolio well. Clearly, Ethereum is going to survive, and if you have a long enough time horizon, it'll be $10,000 in 3, 5 years. Probably less, but if you have a 3 to 5 year time horizon, that makes sense that it's probably going to be that price point. It's a big world, and there's going to be that much demand. But too short a time horizon, it's going to drive you nuts, man. So focus on what we really titled this stream portfolio structure and really compartmentalizing how you think about different components of the portfolio. Bew, heyo! Kingmaker, what do you think about Kava, a new incentive scheme, making new developers come into the network? Bring more DApps and yield farming protocols. Kava's been around a while. I have micro position in them for like 2 years now. Lovely. I don't really think much of it. I think that the Cosmos ecosystem has a long way to go. I look forward to seamless cross-chain interoperability. I look forward to Cosmos getting into the bridges, the routers, and the cross-chain messaging. That's the trifecta. Obviously, routing and bridges. That's Synapse and multi-chain and cross-chain messaging. Now multi-chain has it, but that's Stargate, and there's a couple of others that are into cross-chain messaging. So I the real churn of capital is on Ethereum mainnet. It's expensive to operate on. At some point, nobody's going to be operating on Ethereum mainnet. When Ethereum's 10, 15, $20,000, nobody's going to be operating on Ethereum mainnet. People are going to be operating on L2s, Arbitrum, um, Optimism, and ZK, as well as the Alt L1s. There'll be no reason to operate on Ethereum mainnet anymore. But this is probably a couple years down the road, 1, 2, maybe 3 years. It's quite interesting. Shisho lost 90% of the portfolio on Geist and Multi. Um, Pause, breathe, and for the love of God, protect your capital. This market's going to continue to shit the bed. There is no making that capital back in this market. Just really think about um, just protect your capital. Geist, we know why it shit the bed, and Multi still doesn't have E Multi. It has decent monetary policy, but monetary policy and narrative tell you where to look. Price action ultimately tells you when to look. The most important thing of an asset in a portfolio is to not love it. Your allegiance is to the portfolio. So if technicals tell you that an asset isn't aligning with the narrative, isn't supporting or manifesting the narrative, you get rid of it. No matter how much you like it, you got to sell this shit. Now, if an asset is respecting the narrative, that's great. Now you found something that has sustainability and has something that likely has longevity. I don't have a capacity to tell you, my friend, how to make capital back. The only thing I could tell you is how to think about these markets and how to structure a portfolio in a way that's not going to drive you absolutely nuts. I wish you the best. It's not easy, and obviously, we've all lost capital. Give it time and take some pause and try and think about, learn from it. That's the most important thing. And you have to attack the market in a sustainable way. Liv, have you been following what's been going on with waves? Yeah, it went vertical, and anything that goes vertical is going to go down vertical, and that's just the nature of these assets. The volatility is extraordinary. So, yeah, it's interesting. I'm not interested in it, though, personally. Tim, would you sell and rebuy your CVX if you didn't have it locked? Probably. Kingmaker, thanks. You're very welcome. It's a pleasure. Patrick, is HODL still a decent strategy with medium time horizon? HODL is too vague. So I like the concept. Like, for instance, my locked assets are forced HODL positions. But the thing that uh, disturbs me about HODL is that it's obviously applicable to persons that don't understand the nuance of financial markets. Um, it's the ultimate passive, but passive can be very capital destructive. So don't blind HODL. That's a problem. Um, you can hold, and obviously I have HODL positions because I have locked positions. I have 4 year lock curve, 4 year lock chi, 4 year lock VFXS, 4 month lock CVX. I don't even know. The list goes on and on. So I'm a hodler, a forced hodler, but I'm not voluntarily hodling Bitcoin and watching it completely plummet into $30,000 territory. I'm not going to blindly hodl Ethereum as it plummets into $2,500 territory. I mean, this thing's barely holding under $3,000 as we talk. Don't blind hodl things. But the interesting thing is like hodling of the locked assets. You're talking about capital controls. So other people are hodling as well. And they're forced to hodl. There's no, are they hodling? They are hodling because they are locked. So capital controls really changes everything. And it's really an MMT monetary policy or MMT ideology of sorts. So don't just blind hodl, my friend. Um, Shisha, thanks for the input, but it's hard to be that positive with 90% plus losses. I absolutely understand. I don't have solutions. My wife always complains to me that I try and fix everything. I think it's a typical male complexity where men try and fix everything. Look, I'm thinking if I could say something that would magically help you, but I can't. And uh, my wife would be like, "You can't fix everything, Noah. You can't help everyone, Noah." Well, I wish I could. And that's why I literally just sat here talking to you guys for 45 minutes because I wish I could help people do better and how to have a sustainable mentality such that you're not anxious. You're not, am I going to lose money? Yeah, you're probably going to lose money in your volatile assets, but if you compartmentalize the way you think about volatile assets, that's okay. I only have my stables. And I'm measuring my stables relative to how much I had back in 2020, the start of the cycle. And I'm happy. Now, obviously, I had like 4 times as many stables at the top of the market, but that's okay. I understand where I was at the peak of exuberance, but I understand where I am relative to where I started. And I'm happy with that. And that's the most important sentiment to have, to find your happy place. Like Happy Gilmore, happy place when he's on the little horse and he's got the little guy and his grandma's there happy. So happy place. Find your happy place. Staked Ethereum is your main forest hodl. Okay. I very much buy into the Ethereum 2.0 narrative, the 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 triple halvening. It's going to become a deflationary protocol of -2% or more per year, and that's massive. And I guess it is very consistent with what I'm talking about. Whether it's STF or RF or Rocket Pool, or maybe you just put your Ethereum into an F 2.0 node. Great. That I would actually say is more interesting than STF versus RF, but all of them are quite interesting. If you have a long enough time horizon, I love Ethereum. Can you not be in position now and buy back at 2,500 or 2,000 when the bond market completely shits the bed? Probably, and you'll have more Ethereum, so that's obviously what I say that I'm probably going to do is, have stables and buy the bottom. So that's probably what I'll end up doing. I probably want an Ethereum position. What we'll end up doing is the contrarian thing. Instead of like, oh, I'm going to buy the bottom and put all my capital in, I'm probably going to buy an undersized position. And I'm probably going to try and focus more on my stable coins. In the most bullish of markets, I'm going to always have a stablecoin position and try and keep it a large percent of the portfolio. How about that? You know why I do that? Because it's a contrarian thought. What if I keep 30% of my portfolio always stable coins and I'm always carving out profit? I'm always carving out maintaining a certain percentage, like 30% of the portfolio stablecoins, always. So as much as assets are appreciating, I'm selling them. I'm keeping that portfolio balance. And that's quite interesting. That might prove very effective. So I'm trying to think during these extremely bearish times in the market of ways to engage with the market during bullish times that are increasingly sustainable, increasingly healthy, and increasingly rational. I'm going to wrap this up in a minute. Dennis, do you increase or decrease stable position when you see crypto go down like last week? Don't think about it. I'm selling on the way down, selling on the way, sell on the way down, sell on the way up. What's most important is the balance of the portfolio, and what's most important is being able to sleep at night. If you are overexposed to an asset and you are uncomfortable, you have overpositioned. You have oversized the position of the asset. To achieve comfortability, reduce the position size. Johannes, thank you, Noah. Very much appreciate it as always. I hope you had a great week in Miami. I very much appreciate the appreciation that you're appreciating at the moment. I appreciate all you guys. You guys listen to me vent and talk about all these things. And this is me trying to understand how best to engage with these absolutely wild markets. 74 people in the stream, 35 likes. I'll say we have done better. That's extraordinary for these crazy bear market conditions. So I thank all of you for joining. I wish you all a wonderful day. Monday, April 11th at 12:22 p.m. Please, anyone, if you need any assistance, I have my direct one-on-one still, and if anyone is on Discord, I'm more than happy to help there as well. But I will see you again.